Hi, my name is Darren Joseph from HTJ.tax. We're the team that seeks to demystify this sometimes confusing world of international tax and the privilege of having a deep conversation with Mark. Mark, can you please introduce yourself?
I'm Mark Morris. I'm based in Switzerland. I've been here for about 26 years. I've specialized in automatic exchange of information, which originally was the EU Commission's EU Savings Tax Directive. And that went on until about 2014, and they scrapped that and they adopted the OECD's FATCA made into CRS.
So can you share with us what it is you do professionally?
Primarily, I provide custodial services for trusts to hold underlying entities or partnerships or unincorporated funds. So what I do is I provide the administration services for the custodial. I don't do the actual custody. And later on, I'll explain what administration services for custodial is. And I'm an expert in CRS and CARF, and I certainly know the intricate differences between CARF and CRS. We'll get into that in a later question, okay? I've published over 600 articles on LinkedIn, and I'm still writing about 10 a week. And I don't see other people covering 99% of the topics on CRS that I cover.
Okay, thank you. What's the main difference for investment entities between CARF and CRS?
Okay, so in 2021, the single largest case of tax evasion in US history for an individual was a private equity investor called Robert Brockman. And Robert Brockman had investment entities. 90% were in Nevis, 10% were in Bermuda, and he used two Swiss banks as SYZ and Mirabaud. And guess what? He registered for a gin, and he gave the bank a gin. And once the bank saw a gin, they just stepped back and they said, we don't have any more due diligence to do. That's why the CRS you don't need the gin anymore. And then it was up to him to report on reportable persons. And this wasn't a loophole. What he did was he just said there's nobody to report on, no reporting. And so that's not a loophole. There was a 40-page report by the US Senate Finance Committee called the Shell Bank loophole. They're using the wrong word, but I understand what they're getting to. They're saying if you're an investment entity, you're like a bank, and then it's up to you to report. So there was questions, why didn't Mirabaud report? Because 700 million came in several times, and they still didn't report. Well, I don't blame them at all, because CRS said, don't report. Remember, I said the core principle is if your account holder is a financial institution and you, the financial institution, maintaining those assets, you don't report, even if it's fishy or not. So the OECD knows about this weakness. Now, it should be up to the country where you're in to say you didn't report for CARF, you didn't report for CRS, let's do an audit who owns you. But they don't do that.
Yeah.
So what did the OECD do about this weakness? When they introduced CARF as an extension of CRS, they said investment entities are now transparent and you must look through them. They keep the investment entity category as is. That means the investment entity must also report. But the bank or crypto service provider maintaining the crypto must look through it and report on all controlling persons, whether any of those controlling persons in the chain going up are FIs or not. To me, that's the biggest difference between CRS and CARF, besides saying who's a financial institution for CARF and crypto is a financial asset.
Okay.